Hey there! Today, let's take a closer look at the US debt ceiling breach and its consequences. Is the US debt ceiling standoff going to destroy your portfolio? CNBS reports that the debt limit debate, which puts the nation's credit and trust on the line, endangers the already fragile US economic outlook. Treasury Yellen says failure to raise the debt ceiling would be an economic catastrophe. Warren Buffett said it was a mistake to have a debt ceiling a decade ago. Are Democrats and Republicans walking towards the debt ceiling by the end of May? There is still no agreement, but time is ticking. Why is the US debt so high? Well, the following have contributed significantly. Government spending. The US government has been spending more money than it collects in revenue through taxes for years. This leads to budget deficits, meaning there is a shortfall between expenses and income. To cover these deficits, the government needs to borrow money, increasing the US debt. Wars and defense spending. Military conflicts and defense spending are significant contributors to the growth of the US debt. Wars like Iraq and Afghanistan wars required substantial funding, leading to increased borrowing. Social programs. Programs like Social Security, Medicare, and Medicaid, which provide benefits to retirees and low-income individuals, contribute to the debt. As the population ages and healthcare costs rise, the government spends more on these programs, adding to the debt. Tax cuts. Tax cuts aimed at stimulating economic growth and providing relief to individuals and businesses can result in decreased government revenue. If tax cuts are not offset by spending reductions, they can contribute to higher deficits and debt. These factors, combined with other economic and fiscal policies, have led to a significant increase in the US debt over the years. As the debt grows, the government needs to continue borrowing to cover its obligations and interest payments, which can lead to a further increase in the debt burden. The consequences of reaching the US debt ceiling can have significant impact on the economy and financial markets. Here are some potential consequences. Government shutdown. If the debt ceiling is not raised and the government runs out of borrowing capacity, it may not have enough funds to pay all the obligations. This could result in a government shutdown, where non-essential government services are suspended and federal employees may be furloughed and face delayed payments. This can disturb government operations and impact various sectors dependent on government services. Default on debt payments. The US government issues treasury bonds and securities to borrow money from investors. If the debt ceiling is not raised and the government exhausts its borrowing capacity, it may not be able to make timely payments on its existing debt. This could lead to a default on its obligations, damaging the US government's creditworthiness and reputation as a borrower. Financial market volatility. A failure to raise the debt ceiling can trigger increased volatility in financial markets. Investors both domestically and internationally rely on the US Treasury bonds as a safe investment. A default or even the risk of default can erode confidence in the US government's ability to repay its debts. This can lead to increased borrowing costs for the government and higher interest rates across the economy, affecting businesses, consumers, and investors. Downgraded credit rating. If the US government defaults or comes close to defaulting on its debt obligations, credit rating agencies may downgrade the country's credit rating. This downgrade can make it more expensive for the government to borrow money in the future and have broader implications for the stability of financial markets. Negative economic impact. The consequences of debt ceiling standoff can harm the overall economy. Uncertainty surrounding the government's ability to meet its financial obligations can reduce business and consumer confidence, leading to decreased investment, lower consumer spending, and lower economic growth. It can also have implications for international trade and the value of the US dollar. Given the potential risks and negative consequences associated with the debt ceiling, policymakers generally work to raise or suspend the debt ceiling to avoid these outcomes. However, the process of raising the debt ceiling can sometimes involve political debates and negotiations, making it a topic of concern and uncertainty in the fiscal landscape. In the past, the US has experienced instances where the debt ceiling has been reached or temporarily breached. However, the consequences have varied depending on the specific circumstances and actions taken by the government. Here are a few notable examples. Debt ceiling crisis of 2011. In 2011, the US reached a point where it was close to reaching the debt ceiling. The prolonged debate and political gridlock over raising the debt ceiling led to concerns about a potential default. As a result, credit rating agency Standard & Poor's downgraded the US government's credit rating from AAA to AA+. Financial markets experienced increased volatility, and there was a general sense of uncertainty. Eventually, an agreement was reached to raise the debt ceiling, but the episode had an impact on the market confidence and economic sentiment. Government shutdown and debt ceiling standoff of 2013. In 2013, a political standoff over the budget and debt ceiling resulted in a partial government shutdown. The government reached its borrowing limit, and without an increase in debt ceiling, it faced the risk of default. The impasse led to temporary shutdown of non-essential government services and had a negative impact on government employees and the economy. Eventually, an agreement was reached to raise the debt ceiling and reopen the government. It is important to note that each debt ceiling episode can have unique circumstances and outcomes. While the US has not experienced a full default on its debt, the uncertainty and potential for default or delayed payments can lead to market volatility, increased borrowing costs, and loss of confidence in the US government's financial stability. So, what will the 1st of June deadline bring us this time? Will the debt limit debate, which puts the nation's credit and trust on the line, endanger the already fragile US economic outlook? Will this put downward pressure on the world's financial markets? Soon we will have our answer. Stay tuned.